Time now for our Muni moment, and today we're focusing on the financial health of smaller US colleges. They're being hit with rising costs and falling enrollment. Bloomberg's Nic Querolo has been covering this story and joins us now. And Nic, thank you so much. Take us to this story in an anecdotal way. So tell us, for example, about Albion College.
Sure. Albion is a school that last week ran into some financial difficulties. Like many of these schools, they sell debt in the municipal bond market, and their debt fell into distress after they broke two covenants in their debt agreements based around some of their financial ratios. So it's just a great example of a small school in a rural area that's really feeling constrained by some of the demographic changes we're seeing in the U.S.
Yeah, and what does it then tell us about the landscape more broadly, Nic? If this is one school, is it just, one anecdote, or can we extrapolate from there?
No, I think investors and analysts in this space have been watching pretty closely, and they expect a lot of instances like this. There are fewer children being born in the United States. There's less of a value proposition around a U.S. degree nowadays, and a lot of that is translating into fewer applicants and fewer students in seats. And realistically, the United States is facing a problem where many of these small schools that draw particularly from small regional areas are going to have to start to target new types of students or find new revenue streams because the pressures are mounting on them.
What types of schools are facing the most pressure here, and what are the biggest issues here? Is it the cost side being the bigger issue, or the enrollments themselves?
I think the really big issue stems from enrollment and admissions. So we wrote a story a couple weeks ago trying to measure about every small school in the United States, and we talked to quite a few experts who advised us that some flags that you might want to look at include an acceptance rate and a yield rate. Are more students applying? Are they accepting more students? And are fewer of them saying yes to those offers? You want to look at long-term enrollment trends. Are they losing students consecutively year after year? Are they losing money? What's their operating margin? And how much are they giving students in aid to get them through the door?
What is the end game here? Put this issue into context. If the smaller schools in the country are facing this type of financial stress, what is the direction of travel?
I think that there is a bifurcation happening. That's really how the experts talk about it. Your name brand schools, your Harvards, your Yales, these are schools that are seeing their acceptance rates drop. They're becoming increasingly competitive, and some of them are selling 100-year bonds. They are going to be here for as long as any of us can realistically think ahead. But then on the opposite end of the spectrum is you have these schools that are small, maybe less brand recognition, and not as competitive. And realistically, they're probably going to start to close. Fitch expects 15 to 25 closures a year going forward. And that has implications for investors who are holding college debt, for parents and students who are paying tuition, and for the scores of people that these colleges employ.
Yeah, Nic, you mentioned some of the Ivies there. We all know that right now there's plenty of donors that are at least threatening, and some have already decided to take away their funding. Does this potentially benefit smaller colleges at all, or does that funding just go away?
I think the funding, those are probably separate issues, but I think really what the big issue on the small colleges radar is just the enrollment trajectory in the United States and how they are able to, diversify themselves away from your kind of traditional liberal arts offerings.
So, Nic, just more broadly now, November saw the best returns to municipals since basically the Paul Volcker era. What's the outlook for December and January and into the first quarter?
A lot of muni market investors are watching pretty closely. Obviously, December is a notoriously quiet period in munis. We have seen rates pretty aggressively high and ratios pretty expensive. So I think this is a pretty exciting period for muni investors. And most of the people I talk to are talking about all the tax advantages. Obviously, income on municipal bonds is tax exempt. We are hearing a lot of excitement in munis.
Where is the opportunity here, and where is the pain? I mean, we started this conversation off about the school systems facing such pressure, and it really begs the question about a resolution process. I mean, municipal bond investors, how much more pain is there really to be seen in this higher rate environment?
I think there probably will be some. A school closure is a really difficult, complicated process. One great example is a school that we wrote about in upstate New York called Cazenovia College. They had about, I think, upwards of 30 million, 50 million of municipal bonds outstanding. And when the school closes, it really becomes kind of a graveyard for the investors. They are the people who tend to have the highest ranking on the assets of the school. And the school assets are pretty complicated. Like, think of an endowment. A lot of people give to an endowment and they earmark their money. That's not something that an investor can necessarily tap into to make themselves whole on a bond. So these are really lengthy, complicated processes. They usually involve lawyers, sometimes state attorneys general. But as we start to see these school closures, we're probably going to see, like I mentioned earlier, some bifurcation, some schools really coming away from this that are able to successfully pivot into new types of programs, whether that's career focused or new master's programs, or something that a lot of the schools we talked to brought up. Those schools will probably see some strengthening, and schools that aren't able to pivot or find new types of revenue streams are going to probably struggle a little bit.
You know, to Vonnie's question about these broader questions about the muni market, just a couple of weeks ago we had reported that BlackRock is one of the large players that believes that the broader rally in the muni market is likely unsustainable. So what's the setup going into next year?
Yeah, I mean, there definitely have been some headwinds. One big story that we've been focusing on a lot is Citi's announcement that they are closing their public finance department. They were one of, for years, a massive, gargantuan player in this market. And over the last decade or so, we have seen a steady decline of muni bond underwriters working in the municipal world. This is something that comes up on almost all my interviews. Investors are really concerned about kind of the implications, particularly around liquidity. Citibank had this reputation of being a reliable bank who would come in and provide liquidity, especially in really challenging times. So thinking the pandemic, when there was all this massive sell-off happening and nobody could find holders for the debt. We probably will see some other banks. I think we wrote a profile about Jefferies really rising up the ranks in the underwriting tables for munis. They have taken some real market share there. But obviously, this is a really tumultuous time as we're starting to see, big banks think about and talk about what is the future of their public financing, how profitable is it, and what's the outlook.
Yeah, it was fascinating. I was going to ask you about whether there were repercussions. What about ratings, Nick? Will there be re-ratings at all if the Fed moves on interest rates substantially next year as the market expects, or even the 3 times that the Fed is anticipating right now?
So for credit ratings, particularly in munis, issuers tend to not be very rate sensitive. It's a little bit separate from your traditional fixed income market in that way. You think of like a local government, for instance, they need to build a new bridge or a road. They tend not to, because these processes move so slowly, they are not very sensitive to swings or trajectory in interest rate, because these are very demanding less time-sensitive issues. So if a government's going to build a bridge or a school is going to issue bonds, they tend to do it on their own timeline based on their need, not necessarily the interest rate environment.